Welcome to another weekly general update for the 31st of March, and it's been a pretty interesting week again, and we're maybe at the point of major reversal in some long-term trends that will be very interesting to look at. Just a reminder, this is general advice only. You need to be considering your own personal circumstances before you make any trading or investment decision. Now, one of the key things going on in the market at the moment is in the bond market, and really stock markets are following what happens in bond markets and currency markets. So it's really instructive to watch what's happening there, and I believe that we may be at the start of a really big picture change in trend in bonds, which have been really running very, very hard now for about 3 decades. We'll have a look at a chart on the next slide that depicts that. And really, I guess people have been calling for a reversal in the bond market and a rise in interest rates now for some time. So I just want to have a look at why they've stayed so strong and yields so low for such a long period of time. Now, there's a couple of reasons. The first is that there was a real flight to quality, or perceived quality, in going into government bonds that were perceived as being lower risk than having your money anywhere else. I think over time that'll prove to be incorrect, and certainly the people that bought into Greek government bonds and lost 70% of their money wouldn't be thinking that it was too much quality. And it's largely because of the situation in Europe. Now, I think why we might be getting a reversal at this point is that fears over what was happening in Greece are now receding. Yes, there's some anxiety over Spain, but the ECB has basically shown that they're going to print whatever they need to keep things on the right path in Europe. So because those fears are receding, I think people are now perceiving that there's no need to be hiding in so-called safe havens. Previously, there's been an expectation for little economic growth and certainly no inflation, and as a result, people were happy to leave their money in the safety of bonds. But with the US jobs report trending higher now for 3 months in succession, it's really now starting to support an expectation that economic growth around the world is going to start increasing, and with that we'll see some inflation. And so people that have had their money hiding in effectively zero return bonds are now thinking, well, if we're going to have some inflation, I need to get a better return on my money. And so money's coming out of the bond market and starting to head towards other higher risk categories. And the third reason is that the Fed has been deliberately suppressing the bond market in order to stimulate the US housing market. So they've been doing various things to try and push the long-term yields down and the prices of bonds up. But that program, which has been called Operation Twist, is coming to an end in June. So unless they come up with something else to replace it, which is of course entirely possible, that we could be seeing the end to this this overall suppression in the bond market. And ultimately, it's market forces that win out. The governments can influence things for a period of time, but ultimately it's market forces will win. And this is a very long-term chart going back to the 1960s of the 10-year Treasury yield in the US. Now you can see we had a period of rising interest rates or falling bond yields for a period of time, falling bond prices for a period leading into the 1990s, and then we've had a substantial decline over the last 2 to 3 decades that have taken bond prices to a real high and yields to a real low. So there are certainly some signs that we may be getting a bit of a turn, and we'll have a look at a shorter term chart on that shortly. So if you do happen to have your money in a bond fund, then to my way of thinking, look out below, because the value of bonds are going to fall in a rising interest rate environment, which, if we're not there yet, is inevitable. And so whilst you might continue to receive your expected interest payment, which is currently pretty low, you can also expect to see a loss in capital value that could well and truly exceed your interest payments. So I think we're at the stage of the cycle now where bonds are a really, really bad investment. And the risks just are not in line with the returns at all. So let's just have a look at the 30-year Treasury yield in the States. And you can see that we've been in a very substantial downtrend, which really started in 2011 in February. In fact, if we go back even further, it's been going basically since we saw a real spike in 2009 after the GFC. Now you can see we had a little bit of a blip occurred in October of 2011, and then the market settled back down again. Now we're getting another little blip, so it's possible this could also just settle down again. But really on Friday was the first time we retraced over the last 7 or 8 days. We retraced exactly 50% of the move that started in early March, and then on Friday it started to spike back up again. So this to me is looking a little bit different to where we were back in October of last year. So I think there's a much better chance now that we're at a reversal point in the bond market, and that will prove to be significant. It'll certainly be very positive for stocks, and it'll be very positive for commodities. Now let's have a look at the action for the week. The S&P overall gained 11 points, and I'm thinking for a period here we might just see some choppy sideways to upwards action as the most likely outcome. The markets have been overbought for a long time. Quite often that overbought condition gets changed by the markets having a retracement, but the other way that it can change is that markets just go sideways for a period and let the moving averages in the market catch up. And I think that's the most likely outcome. So I'm still looking for a run towards 1440 in May, and then would expect to see a bit more sideways to a weaker period into the middle of the year. Now looking at the ASX 200, gained 65 points on the week, and it's really on the cusp of breaking free of the 43.50 resistance that's been tested 9 times already. So I think we're probably just about there. We'll have a look at that chart in just a minute. And banks in the Australian market were clearly the best performers in March. They outperformed energy stocks, they outperformed material stocks, which based on fundamentals, I can't really wrap my head around that, but it's what it was. Investors wanted to go into banks, and they were certainly the best performers. Now looking at bond yields, they eased back about 50%, as I said, and then bounced. The new uptrend still not confirmed, but looking far more likely. However, against that, we're going to have the Fed doing all they can not to let yields rise too far. So it's going to be a pretty fascinating tussle over the next 3 to 6 months. Looking at the US dollar, it was down again, slightly on the week, not a great deal. And is it finding support at the 150-day moving average? We'll have to see. If the US dollar stays around where it is, that'll be fairly positive for stock markets. Now gold rose $5 net on the week. It's likely that it's in a new uptrend and entering a wave 3 pattern higher, which will, if that is the case, will take it to $1,900 and beyond. The GDX and GDXJ gold indicators, gold stock indices in the States, seem to be basing now, so I think we've hopefully seen the bottom in gold stocks. And as I've been saying now for many months, there will be a big surge in gold stocks. There will be a catch-up, there nearly always is. Silver rose slightly as well on the week, so that's the same scenario as with gold. It's going to track along there. Oil was mixed. It remains at very attractively elevated levels. We saw Brent crude rise. We saw the NYMEX light sweet crude fall a bit, but we're still at very healthy levels. And copper is still holding a range just under the $4 a pound mark, and I think we've got a chart on that on the next slide. This is very, very profitable territory for copper producers, so It looks like it's going to hold up in that area. This is the 1 year chart on spot copper. You can see basically all year we've been in this fairly tight band from around $3.80 to just a tick under $4. So all looking pretty positive there on copper. So let's have a look at a few of the other charts of interest now. First of all, the S&P, and I've had this chart now for several weeks. You can see, I believe, the pattern saying that we're now in the fifth leg higher. And within that fifth leg, we've had one run up, we've had a little consolidation, and now we're starting the next leg up. But that could go in a bit of a sideways to upward sloping pattern for a little while to work off this overbought condition. This is the US dollar index. It's really largely been going sideways now for some time. It's on the support of the 150-day moving average. So as long as there's not too much movement upwards in the US dollar, that will be good for stocks and good for commodities. Of course, if the US dollar did break through that moving average and start to slide again, head down below this low of the end of February, then that would also be very positive for stocks and commodities also. Let's just have a look at gold on a weekly chart. So you can see here, I believe that we are in we're in the early stages of a major wave higher. We've had one leg up, second leg down. I believe we're based out at the 61.8% level, and that we're now starting to head higher towards 1900 and beyond. Let's look at the GDX, which covers the 16 biggest gold miners, and this is on a daily chart, and it's just looking to me like it's forming a base here. So I believe we've probably seen the bottom. We're starting to see some divergence now on the RSI. As you can see down the bottom, we've now got a higher high and a higher low. So I think we've probably seen the bottom there. Let's have a look at the juniors. Same situation. The RSI has bottomed out below 30, and we seem to be getting a bit of divergence there. So we're also coming into a seasonally stronger time for gold stocks and gold in general. March tends to be a bit weaker. So there's an awful lot of reasons why we can look forward to a more positive period in gold. Let's just have a look at the Aussie index. Not that the index really affects us that much on what we're trading, but you can see we've had 1, 2, 3, 4, 5, 6, 7, 8, and this is now the 9th attempt to break above this 43.50 resistance level. Had a reasonable go at it on Friday, but again closed on the lows, disappointing. But we've made a break of this wedge, and I think we'll probably see our market start to work its way higher over the next few weeks. So that's it in terms of the general update for this week. I think we're going into a pretty fascinating period. I'm still expecting some good trading conditions for the next month or two, but after that you probably want to be a little bit more careful about your level of exposure in the market. So that's it for this week. See you next weekend. Cheers.
If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.